Everyone, Ariane here. I wanted to make a video recapping my trades this week because I felt like it was a pretty typical week of trading SPX 0DTE credit spreads. So I took one trade on Monday, Wednesday, and Friday. I used the same trading strategy every day. I had maybe on average 3 to 4 hours in the trade, locking my gains, moving on. So I'm not getting into like detailed technical analysis because I just wanted to emphasize how simple it can be to make a weekly income if you just stick to the same trading strategy. So this week I used only $5,000 worth of capital, and on Monday I made $600, on Wednesday I made $450, and on Friday I made $400. So a total of $1,450, and that's roughly like a 29% account growth. So I know on a daily basis, those aren't like huge, exciting gains, but I'm not the kind of trader who like swings for home runs every time. I prefer lower stress, small base hits, consistent gains. And I consider the credit spreads just to be like a relatively lower stress trade versus being like hyper focused on 1-minute charts, scalping these small moves. And I just think those are mentally exhausting. So when you enter a credit spread, you can have a set profit target, which for me is putting in my buy to close order for 10 cents, and a set stop loss, which for me is 3x, so 3 times the credit that I receive when I enter the trade. If the premium happens to reach 3x, just cut the trade and move on. And when you do that, you can live to trade another day. You can make up that loss in one more trade. So I'll get into my 3 easy trades for the week. Okay, so this is the 5-day, 5-minute chart on SPX. Here's my Monday trade, my Wednesday trade, and my Friday trade. And I'll start by going over kind of our Monday trade. So this is how the trade is alerted. It's in Thinkorswim copy and paste format. And it's obviously there's 0 days till expiration. So you pick the same expiry date for SPX. And so this call was at 32.40, 32.45. We filled it at 60 cents. Let's look at Monday. And this is when the call was alerted and when I was filled. Some of my orders were filled for 65 cents, some of them for 60. So this is where I was filled. I put here the top of my call spread. So this is where we do not want SPX to trade. And the reason that we got bearish at this point in the day, which by the way, this is Pacific Standard Time. And it's pretty late entry for us. We typically don't wait this long. But if we go back a few days, let me see this 10-day. Okay, you can see that on the Friday prior to this day, there was a large run up, okay, and a huge kind of gap left here. So we were expecting a gap fill, meaning that SPX would come down and trade here. And that's kind of what we were waiting for. We knew that this was a good point of exhaustion. If you look at the 90-day 1-hour chart way back over here in early June, you'll see that this top here kind of matches up on this top. So we knew that on this day, this would be a good entry. Let me get back to that 5-day, 5-minute chart. So, like I said, we placed our orders here. We filled for 65 cents. And I did not mark my exit on here because I actually let my spread expire worthless, meaning that I did not put my typical buy to close 10-cent order. Had I done that, that order probably would have been filled, somewhere around these candles. But after this like significant move down, we had a pretty confident feeling that the call was going to expire worthless. Here is Wednesday's trade, which was a put credit spread. The strikes were 3180, 3175. This was our entry on this 8:50 5-minute candle. Let's see, 8:54 a.m., 12 or almost noon Eastern time. So another pretty late entry. We were probably expecting that this gap was going to be filled. Obviously, this would have been a better entry because it filled the gap almost perfectly here and then continued up. But there were previous days where SPX was coming down, attempting to fill the gap, but then leaving a couple points here and then continuing up. So I think we just tried to jump ahead of the possible reversal before the gap fill. So, you know, this, we probably would have been able to fill this put credit spread for a better entry price, maybe like 65, 75 cents, maybe a little bit higher. I don't remember. But either way, we got bullish here. It pulled back a little bit further than we were expecting. I put in my buy to close order on this day. Maybe I just wasn't confident that SPX wouldn't like pull some reversal over here and trade lower. So it ended up filling a short while later at 10:05 a.m. and I was out of my trade for the day. So SPX continued to stay higher. So, you know, I could have just let this trade expire worthless, but either because I don't want to be in the trade for all this time and I'd rather just secure my profits here and, you know, not worry about this extra $100, $200. You know, on 10 contracts, I'm basically paying $100 to get out of this trade and close it here. Or on 20 contracts, I'm paying $200 to exit the trade here and not wait until the end of the day when it expires worthless. So that's kind of the sacrifice that I'm making to lock in my gains here. Lastly, let's look at Friday's trade. So Friday is actually a good example of a pretty bad entry, but still a successful, profitable trade. So Friday, we entered here pretty quickly after the bell, filled my 10 contracts for 50 cents. That's what was alerted. I know this doesn't show the time here, but we entered pretty soon after the bell with a bullish bias for the day. Problem is that there was a news event that caused the market to pull back. And I think it was the U.S. Consumer Sentiment Report, which normally I don't think has a market impact like it did on this day. But either way, it was worse than expected. So the market pulls back, but not enough for our stops to be triggered. So we probably could have filled it down here for, who knows, $1, maybe $1.15, but it didn't reach $1.50. So stayed in the trade, put in a buy to close order. It filled here on this candle around 11:05. So still a successful day and happy to close out the week with 3 green, pretty easy trades for the week. So yeah. So that's a pretty typical 3 trade a week trading week for me. Average fill price of about 50 cents, average time in trade about 4 hours. And you know, sometimes, I know this last week we didn't, but a lot of times we've been finding an opportunity to get into a second 0 DTE trade, which we will do maybe an hour and a half or 2 hours prior to the close if there's enough premium sitting out there and if we have a good closing range assumption. We will alert a second 0 DTE, and that is we enter those with the intention of letting them expire worthless so that those members who are subject to the PDT rule will not have to use a second day trade. But yeah, I know I use the word we a lot, and that's because I work with Rick and Joe, and they're better at technical analysis than I am, and I'm usually not the one alerting the trades to our members. But I hope that video helped someone somewhere, and that you guys are having success using credit spreads. I think being a seller of premium versus a buyer and making directional assumptions and not having time decay on your side is a much better way to be a profitable options trader. So thank you for watching. I'm happy to answer any questions in the comments, or you can email me below. Thanks.